Create Your Own Money Machine: How to Use the U.S. Stock Market to Generate Long-Term Financial Independence. Written by Jacob Naiman. Narrated by Randy McCartan. The knowledge and practices in this book are rooted in Naiman's extensive experience, distilling more than 25 years of expertise in his role as a leading investment advisor to the world's wealthiest. The holy grail of this book is to achieve two key goals. Goal 1, increase your wealth by exploiting opportunities in the U.S. stock market. Goal 2, protect your wealth from possible dangers, which can pop up at any given time. To achieve these key goals, you will learn the best and most effective investment strategies for the U.S. stock market. As a result of rapid economic and technological changes, the middle class becomes smaller and smaller each year. The result of this global phenomenon is that in the future, the world will be divided into two groups of people: the rich and established, and everyone else. Here's the truth. As the years go by, if you aren't part of the first group, you'll be part of the second. Fortunately, there's no predestination. You can become rich and established by employing the strategies in Create Your Own Money Machine. The knowledge and strategies outlined in this book are based on Naiman's extensive knowledge and experience, gained over 25 years in his role as a leading investment and economic advisor to the world's wealthiest. Infusing your life with the financial strategies outlined in this book will enable you to achieve the most important goal of the 21st century: financial independence. Introduction. Having a good income is not always enough to secure your economic future. For that, you must also acquire an investment portfolio that will generate long-term income from multiple sources. There are many ways to live and retire financially secure. One of the more practical methods is to use your financial savings as a foundation on which to build and preserve your wealth. The profits produced by your investment portfolio will give you the ability to maintain a high standard of living that suits your present and future needs and desires. For you as an investor, the stock market and economic reality present fantastic opportunities and significant risks. The holy grail of this book is to achieve two key goals. Goal 1, increase your wealth by exploiting opportunities in the U.S. stock market. Goal 2, protect your wealth from possible dangers which can pop up at any time. To meet these aims, you will be introduced to the best stock investment strategies for today's financial markets. The investment strategies presented in this book will enable you to take advantage of the opportunities created by the U.S. stock market while protecting your money from possible unforeseeable risks. As a senior financial advisor in the banking system and an investment portfolio manager in the private sector, I have met thousands of people from many walks of life. While these people were very talented in their specific fields, they generally had limited understanding of financial investments, especially the stock market. When speaking with lay investors about their financial investments and investing money in the stock market, I used clear, simple language, without glossing over the deeper implications of the investment information conveyed. This book has been written following this principle, and is designed for investors who lack an in-depth understanding of the field. The approach described in this book represents a mindset that can be summarized as: hope for the best and prepare for the worst. Yours, Jacob Naiman. Chapter 1. How much money do we need? Quote, never depend on a single income. Make an investment to create a second source. End quote. Warren Buffett. Wealth is not defined as your income level. If your annual income is high, but you spend it all, then you're just keeping up a high standard of living, for now. Wealth is defined by what you save, not what you spend. The process of building wealth is simple. Make money, save money, invest money. Wealth building is the process of investing your money in a way that will create an income-generating asset. How much money do we need? In order to feel financially secure, most people reply that they need at least $150,000 a year. If you consider a couple in their 30s with 2 children, this figure certainly makes sense. Assuming that the average life expectancy is 80 years, a simple calculation shows that this couple will need an aggregate amount of $7,500,000 in order to maintain a reasonable standard of living over the next 50 years. One practical way to generate additional income is to manage our finances in an optimal manner. We can do this by building a private investment portfolio. The main points. Having a good income is not always enough to secure your economic future. For that, you must also acquire an investment portfolio, a money machine, that will generate long-term income. Chapter 2. Investor Psychology. Quote, "Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble in investing." End quote. Warren Buffett. In the process of building and preserving your wealth, it is important from the start that you, as an investor, adopt two important principles to guide your mindset and actions. Don't make hasty decisions. The basic cliché is that speed is from the devil, and this is true in the context of investments as well. In the field of investments, an investor who displays patience and restraint will achieve better results than an investor who is not endowed with the same qualities. Practice safety. The central issue in building and preserving wealth is how to invest the money. The safest way to invest your money is to apply the famous golden rule: don't put all your eggs in one basket. If you have built your investment portfolio properly, using the golden rule of diversification, then even a stock market crash shouldn't worry you too much. The main points. Don't make hasty investment decisions. Practice safety by diversifying your portfolio. Chapter 3. A good trading platform. To effectively implement asset management, you must find a good online platform that will allow you to do so. What are the criteria for a good platform? Low commissions for performing financial transactions, e.g., buying and selling stock market securities or financial products. An online connection to your bank account or brokerage account to be able to sell and buy financial products independently. Excellent trading platforms that provide added value to the management of your investment portfolio. Quality of service, measured by availability, professionalism, and the reliability of the information you receive. There are two financial entities that allow access to buying and selling on the stock exchange. 1. Banks. The commissions are usually high. 2. Stockbrokers, the recommended way to manage stock market investments. While brokerage accounts are managed through a website, every major broker also has a phone number that includes the following services. 1. Service representatives to answer your questions. 2. Trading halls. Rooms with many screens that allow representatives to see in real time what is happening on various stock exchanges around the world. If you decide to use a broker, it is better to work with the largest, most stable, and best-known broker. The larger the broker, the more assets are backed up. The main points. Low commissions for buying and selling securities and financial products are very important for your financial activity. If the commissions at the bank are too high, consider working with a big brokerage firm instead. Chapter 4. Stocks versus bonds. Stocks and bonds are the two main methods of investment in the stock market. Stocks, or shares, are a direct investment. You give money to the company and become a co-owner, with holdings proportional to the percentage of shares you purchased. As a shareholder in the company, you are also entitled to dividends paid by the company. When you invest in bonds, you are essentially giving a loan to a publicly traded company, corporate bonds, or to the government, government bonds. In return, you receive a guaranteed, predictable cash income which will be paid on a specified future date. For example, if you purchased a corporate bond that has 5 years to maturity and an annual coupon of 7%, then you are guaranteed to receive a coupon of 7% in each of those 5 years. Essentially, you gave the company a loan that gives you a 7% annual interest rate, and your original bond sum will be returned to you upon completion of the 5-year period. The fundamental difference between stocks and bonds. Unlike bonds, company shares have no guaranteed return. In other words, they do not guarantee a predictable cash flow to be paid at a specified future date. When you hold shares, you rely on their market value. When you hold bonds, you have a chance to get the guaranteed return, even if the company suffers financial difficulties. The main points. A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. A bond is a fixed income instrument that represents a loan made by an investor to a borrower. Unlike bonds, company shares do not have a guaranteed return. Chapter 5. Get higher rewards with minimal risk. The only situation in which you should be willing to tolerate higher risk is one in which you expect to be rewarded with higher profits. In wealth management, you have a powerful and effective tool to reduce your portfolio risks while maintaining higher rewards. This tool is called asset allocation. Asset allocation. Asset allocation is an investment strategy that aims to balance risk and reward by apportioning a portfolio's assets in different investment channels: stocks, commodities, bonds, and cash. How does asset allocation reduce risk? The returns of stocks, bonds, commodities, and cash do not move in unison. Market conditions can lead to one asset class outperforming during a given time frame, but cause another to underperform. This kind of market behavior balances and reduces the volatility of the entire investment portfolio. For example, you can invest your money by applying the rule of thirds to asset allocation. Invest 1/3 in real estate and commodities. Invest 1/3 in stocks and bonds. Invest 1/3 in money and its equivalents. The main points. Asset allocation is a powerful tool to reduce your portfolio risk while maintaining high returns. Greater risks should be taken only if the potential return is high. If not, the risk should be avoided. Chapter 6. The advantages of ETFs. It is highly recommended that you invest your money using ETFs and not by investing in specific stocks. Investments in specific stocks/companies have no place in the construction and management of assets. Both beginner and experienced investors are advised not to try to invest in any particular company. If you invest in individual stocks, you expose yourself to high risk without the reward of higher returns. What is an index ETF? An exchange-traded fund, ETF, is a basket of securities that trades on an exchange just like a stock does. Typically, ETFs will track a particular index, sector, commodity, or other asset. With an index ETF, you, as an investor, gain exposure to numerous securities in a single transaction. The first ETF was the SPDR S&P 500 ETF, SPY, which tracks the S&P 500 index. How to choose the best ETFs. When you decide to buy an ETF in a specific sector, commodity, or index, you will find that there is more than one financial entity that manages such an ETF. So how do you know which ETF to choose from the list of ETFs? The golden rule is to choose the ETF from the 2 or 3 biggest ETFs in the investment product sought. For example, let's say you decided to purchase an ETF on gold, and there are at least 10 ETFs from different financial entities that can be purchased. The rule of thumb is to examine the 2 or 3 largest entities in terms of asset management scope, and to invest in the one with the lower management fees. The main points. If you invest in individual stocks, you expose yourself to high risk without the reward of higher returns. Choose the ETF from the 2 or 3 biggest ETFs in the investment product sought. Chapter 7. Buy ETFs. Don't pick stocks. The better alternative to buying individual stocks is to buy an index that represents the investment channel in which you want to allocate your money. For example, instead of picking and buying 3 or 4 stocks that belong in the technology sector, we can buy an ETF, exchange-traded fund, that represents the NASDAQ 100 index. This allows you to buy a small piece of the stock of 100 different companies in the NASDAQ sector with a single investment. Why investing through ETFs is better than buying individual stocks. Reduced portfolio risk. When you buy ETFs on indexes, the volatility risk of the investment portfolio is much lower than when you invest in specific companies. Reduced portfolio fees. ETFs offer low expense ratios and fewer broker commissions compared to buying stocks individually. The low fees mean that more of your investment stays with you rather than being drained off by the investment house. Improved focus. Base your stock market investment decisions on which investment indexes/sectors are the best to invest in, not the question of which individual stocks to pick and buy. Time savings. In order to invest in individual stocks and do it well, you must invest a great deal of time doing research and a great deal of attention to monitor the stocks. The main points. Buying ETFs on indexes enable you to easily implement the golden rule: don't put all your eggs in one basket. Buying ETFs on sectors or indexes diversifies your investments and considerably reduces the volatility of your portfolio. Buying ETFs on indexes or sectors reduces your fees. Chapter 8. Define your investment preferences. Before you build your portfolio money machine, you must define your preferences as an investor. Your investment portfolio should be built in accordance with your desires and needs. To accomplish this, you need to address the following issues. The amount of money. You have to determine the appropriate amount of money to invest in the capital markets. To do this, you must also consider your other assets and the level of risk to which they are exposed. The investment horizon. The longer the investment horizon, the higher the level of risk you can afford to be exposed to, since your investments will have plenty of time to ride out the market's short-term volatility. Accordingly, the potential to gain higher returns will be greater. If, for example, you know in advance that you are going to purchase a house within the next 2 years, then you shouldn't use this money to invest in the capital market. Why? Because it is possible that the capital market will decline sharply during those 2 years. Since you will be forced to sell your investment in order to buy the house, you will not be able to wait for the market to rise and correct itself, and you will lose money on your investment. Exposure to risk and required return. As an investor, you should decide what weight, percentage, to give the risky and the solid parts of your portfolio. A simple investment strategy is to keep all your money in U.S. Treasury bonds, which have a guaranteed return. The obvious advantage of this strategy is that it's a safe investment with almost no risk, while the disadvantage is that the return on such an investment will be very low. If, however, you are an investor who is willing to take some risk, investment in stocks, commodities, and corporate bonds will increase your chances of earning more money. The main points. The relationship between return and risk is a double-edged sword. To profit more, you must be willing to take more risk. The longer the investment horizon, the higher the level of risk you can afford to be exposed to. Chapter 9. The Rule of Thirds. The main assumption in asset allocation is that the investment in different assets results in diversification, which reduces the overall risk in your investment portfolio while maintaining the level of the return. Asset allocation can be exercised by implementing the rule of thirds. Warning: the securities mentioned here are only examples and do not represent suggestions or any recommendation for what you should or should not invest in. It is highly recommended that you build your private investment portfolio with the help of a licensed financial advisor. The rule of thirds. A wise investor will do the following: invest 1/3 in stocks and bonds. Invest 1/3 in real estate and commodities. Invest 1/3 in money and its equivalents. Each portfolio component, third, has a different role. The liquid third of the portfolio. The liquid component has two objectives. One, by maintaining high liquidity, You create a reality in which your portfolio exposure to the volatility/risk of the financial markets is reduced. 2. When the markets fall considerably, liquidity gives you the ability to exploit opportunities and buy securities at an attractive price using ETFs. Financial products that can be included in the liquid component of the portfolio: deposit accounts, short-term government bonds, money market funds, certificates of deposit, CDs, including foreign currency. The market third of the portfolio. The expectation is that the market component of your portfolio will produce returns/profits close to the market benchmark. Financial products that can be included in the market component of the portfolio: ETFs on sectors such as banks and technology, ETFs on major indexes such as the NASDAQ 100, S&P 500 index, Dow Jones, government bonds, medium term, with an average maturity of up to 5 years, corporate bonds with high ratings, A or higher, medium term, with an average maturity of up to 5 years. The alpha third of the portfolio. In the alpha component, you adjust your portfolio to include the indexes, assets, or sectors that are riskier and show the most potential for gains. The expectation is that the alpha component of your portfolio will outperform the market benchmark. Financial products that can be included in the alpha component of the portfolio: stocks, crypto, digital currency, corporate junk bonds with high yields, ETFs on REITs, commercial or residential real estate, convertible bonds, warrants, options, ETFs on commodities such as gold, petroleum, and agriculture products, ETFs on small cap stocks such as the Russell 2000 Index. The main points. A wise investor will do the following: invest 1/3 in stocks and bonds, invest 1/3 in real estate and commodities, invest 1/3 in money and its equivalents. Chapter 10. Preserving the Rule of Thirds. In the process of wealth building, one of the most important actions is to maintain the portfolio asset allocation. Why is it important to maintain the rule of thirds? Because it enables you to implement the golden rule: don't put all your eggs in one basket. The rule of thirds. Invest 1/3 in stocks and bonds. Invest 1/3 in real estate and commodities. Invest 1/3 in money and its equivalents. Balancing your portfolio means buying and selling securities in a way that will return the portfolio to its desired risk levels. For example, due to an increase in share prices in the stock market, the market and alpha components in the portfolio can grow considerably. Let's assume that after 3 months they each grow from 33% to 40%. So now we have a portfolio with only 20% liquidity, not the 33% you intended to have when you were first building your investment portfolio. What should you do in this scenario to rebalance your portfolio? In the process of rebalancing, we will sell 7% of the alpha component and 7% of the market component, and the money from the sales will be reinvested in relevant products in the liquid component. The result of this rebalancing process will be a balanced portfolio that maintains the rule of thirds. The maintenance process. Check your investment portfolio every 3 months to see if it meets the rule of thirds. If necessary, rebalance to maintain the desired asset allocation. When the ETFs go down, buy more shares to rebalance. When the ETFs go up, sell some of the stocks and materialize profits to rebalance. The main points. Rebalancing involves periodically buying or selling assets in a portfolio to maintain its original or desired level of asset allocation. In the process of rebalancing every 3 months, maintain the rule of thirds. Chapter 11. When is the right time to buy? Quote, "The best chance to deploy capital is when things are going down." End quote. Warren Buffett. You can think of ETFs like a train running along the market's trend line, i.e., the tracks. You, the investor in those ETFs, are not the train driver, but a passenger who can choose when to get on the train and when to get off. As an investor who manages their own personal portfolio, you decide when to buy and sell ETFs and the amount of your investment. Those decisions will impact your return. When you want to invest your money for the long run, you can adopt Warren Buffett's strategy. Quote, "I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful." End quote. To achieve alpha returns, which sectors should we focus on for the long run? The answer is straightforward. The sector or sectors whose prices have decreased considerably, over 35%. If, for example, the technological sector in the market has gone down by 32% and the inflation is at 8%, we can consider buying an ETF on the NASDAQ after it goes down 32 plus 8%. If it continues to go down, say by an additional 10%, we can buy more. There is a high probability that after several years, the technological sector will rise again and we will enjoy nice profits from our original investment. When you see that the market is coming close to its peak, i.e., the market is saturated, you can decide to materialize some of your long-term investments by moving some of the money to less risky investments, namely solid ETFs. The main points. If you have the opportunity to buy securities in a sector or an index at low prices, then increase your exposure to this index or sector. Implement Warren Buffett's golden rule, quote, "Be fearful when others are greedy. Be greedy when others are fearful." End quote. The 5 guidelines for becoming financially secure. 1. Create your own money machine. Having a good income is not always enough to secure your economic future. For that, you must also acquire an investment portfolio that will generate long-term income. 2. Don't make hasty investment decisions. In the field of investments, an investor who displays patience and restraint will achieve better results than an investor who is not endowed with the same qualities. 3. Buy ETFs. Don't try to pick individual stocks. Buying ETFs on sectors or indexes diversifies your investments and considerably reduces the volatility of your portfolio. 4. Implement the rule of thirds. Invest 1/3 in stocks and bonds. Invest 1/3 in real estate and commodities. Invest 1/3 in money and its equivalents. 5. Implement Warren Buffett's golden rule, quote, "Be fearful when others are greedy. Be greedy when others are fearful." End quote. If you have the opportunity to buy securities in a sector or an index at low prices, then increase your exposure to this index or sector. Final thoughts. Remember, you won't earn prizes just for knowing things. You'll only be rewarded for your actions. This book contains valuable information. Use it. If this book has helped you to better understand the process of becoming financially independent, I would greatly appreciate your review on Amazon. Thank you in advance. Jacob Naiman. The end. This has been Create Your Own Money Machine: How to Use the U.S. Stock Market to Generate Long-Term Financial Independence, written by Jacob Naiman, narrated by Randy McCartan.